Preparing for a Loan IQ interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What is Loan IQ and how is it used in the loan servicing lifecycle? Loan IQ is a loan servicing platform used mainly for commercial, bilateral, and syndicated lending. I would describe it as the system that supports the post-origination lifecycle, deal and facility setup, borrower drawdowns, rollovers, interest accruals, fees, repayments, and accounting entries. It helps operations, agency, finance, and risk teams maintain one source of truth for positions, cash flows, and lender shares. While answering, focus on Loan IQ as a commercial lending and syndicated loan servicing platform, covering deal setup, facility management, drawdowns, fees, interest, payments, accounting, notices, and downstream integrations. Question 2. Can you explain the difference between a deal, facility, and outstanding in Loan IQ? I think of the structure as deal, facility, then outstanding. The deal is the overall borrower relationship or credit agreement. Facilities sit under the deal and define limits, currency, product type, pricing, maturity, and lender commitments. Outstandings are the actual utilized amounts, such as a loan drawdown under a revolving facility. For example, a $100 million revolver may have a $30 million outstanding after the borrower draws funds. Make sure to cover the hierarchy clearly. Deal as the overall agreement, facility as the credit line or tranche, and outstanding as the utilized loan instrument created through drawdowns or activity. Question 3. How would you set up a new syndicated loan deal in Loan IQ? For a syndicated deal, I would start with borrower and legal entity setup, then create the deal and attach the relevant facilities. Next, I would enter lender commitments, agency roles, pricing options, currencies, margins, fee rules, calendars, and repayment terms. I would validate limits, dates, accounting setup, and approval workflow before activation. The key is accuracy at setup because downstream accruals, notices, cash flows, and general ledger postings depend on it. In your answer, talk about capturing borrower details, deal structure, facilities, lender shares, pricing options, fees, calendars, repayment schedules, accounting rules, approvals, and validation before activation. Question 4. What happens in Loan IQ when a borrower makes a drawdown request? A drawdown converts available commitment into an outstanding loan. In Loan IQ, I would check facility availability, borrower eligibility, currency, value date, pricing option, interest period, and margin. Once entered and approved, the system creates the loan outstanding, allocates lender shares based on participation, generates notices, and creates expected cash flows. On release, accounting entries and payment instructions can flow to downstream systems depending on the bank's configuration. Be sure to mention availability checks, pricing selection, value date, loan creation, lender share calculation, notices, cash movements, accounting entries, and approval or release controls. Question 5. How does Loan IQ calculate interest accruals on a loan? Interest accrual in Loan IQ is driven by the outstanding principal, base rate, spread or margin, day count convention, and interest period. If a loan is $10 million at 6% using actual 360, the system accrues interest daily based on those parameters. Rate changes, repricing, and rollovers can update the calculation. The accrual then supports borrower billing, lender distribution, accounting entries, and reconciliation with finance records. While answering, focus on principal, rate components, margin, day count convention, interest period, calendars, accrual events, rate resets, and how accruals feed billing and accounting. Question 6. What is the difference between rollover, repricing, and repayment in Loan IQ? A rollover continues a loan into a new interest period, usually at maturity of the current period. Repricing changes the interest rate terms, such as switching the base rate or updating the margin, without necessarily reducing principal. Repayment reduces the outstanding principal, either partially or fully. In Loan IQ, each event affects cash flows, accruals, notices, and accounting differently, so using the correct transaction type is important for clean servicing. Make sure to distinguish these common servicing events. Rollover extends or renews an interest period. Repricing changes rate terms, and repayment reduces principal partially or fully. Question 7. How are fees handled in Loan IQ? Loan IQ supports multiple fee types, including commitment fees, utilization fees, agency fees, upfront fees, and amendment fees. The setup defines the basis, rate, schedule, effective dates, sharing rules, and whether the fee is accrued, billed, or paid immediately. For example, a commitment fee may accrue on the undrawn facility balance. The system can calculate borrower receivables, lender allocations, notices, and accounting entries based on the configured rules. In your answer, talk about common fee types such as commitment, utilization, arrangement, agency, and upfront fees, plus calculation rules, billing schedules, accruals, sharing, and accounting treatment. Question 8. What are lender shares and why are they important in syndicated lending on Loan IQ? Lender shares represent each syndicate member's participation in a facility or outstanding. If 3 lenders commit 50%, 30%, and 20%, Loan IQ uses those shares to allocate funding, repayments, interest, and fees. This is critical for agency operations because the agent bank must collect from the borrower and distribute accurately to lenders. Any incorrect share setup can create payment breaks, wrong notices, and reconciliation issues. Be sure to cover lender commitments, pro rata shares, funded positions, allocations of principal, interest, fees, cash flows, and the agency bank's responsibility to keep records accurate. Question 9. How would you investigate an interest or fee amount that looks wrong in Loan IQ? I would first confirm the economic terms: principal, effective dates, rate, margin, day count, currency, and interest period. Then I would review the event history to see whether a rollover, repricing, repayment, amendment, or backdated change affected the calculation. For fees, I would check the fee basis and schedule. Finally, I would compare Loan IQ accrual reports, notices, and accounting output to isolate whether the issue is setup, calculation, or downstream posting. While answering, focus on a structured troubleshooting approach. Verify principal, dates, rates, margins, day count, calendars, fee basis, amendments, event history, accrual reports, and downstream postings. Question 10. What are notices in Loan IQ, and what information should be validated before sending them? Notices are formal communications generated from Loan IQ for borrowers and lenders. They can cover drawdowns, rate settings, rollovers, repayments, fee billings, interest due, and lender distributions. Before sending, I would validate the counterparty, contact details, amount, currency, value date, interest period, rate, settlement instructions, and template language. Because notices often drive external funding actions, they need operational review and approval before release. Make sure to explain notices as borrower or lender communications, covering drawdowns, rollovers, rate settings, fees, payments, settlement amounts, dates, contacts, templates, and approval controls. Question 11. How does Loan IQ support accounting and general ledger postings? Loan IQ generates accounting based on configured events and product rules. When a drawdown, repayment, interest accrual, fee billing, or payment is released, the system can create debit and credit entries mapped to general ledger accounts. The exact postings depend on accounting configuration, branch, currency, product, and transaction type. Operations and finance teams then reconcile Loan IQ balances, cash movements, and GL feeds to ensure the loan subledger matches the books. In your answer, talk about accounting events, debit and credit rules, accruals, cash movements, product accounting setup, GL mapping, suspense, reversals, and reconciliation with finance systems. Question 12. What controls would you check before releasing a transaction in Loan IQ? Before release, I would check that the transaction has passed maker-checker review and matches the credit agreement or authorized instruction. I would validate amount, currency, value date, pricing, facility availability, borrower and lender allocations, settlement instructions, notices, and accounting impact. I would also check exception messages and audit history. The release step is important because it can trigger payments, external notices, and ledger postings. Be sure to mention maker-checker workflow, required approvals, economic term validation, availability, cash instructions, accounting impact, notices, exception queues, audit trail, and segregation of duties. Question 13. How would you handle an amendment to a loan facility in Loan IQ? For an amendment, I would first identify what changed: commitment amount, maturity date, pricing, lender composition, fees, covenants, or repayment schedule. In Loan IQ, the amendment should be entered with the correct effective date and supporting approvals. I would assess whether existing outstandings, accruals, fees, notices, and accounting need adjustment. After release, I would validate future cash flows and lender positions to confirm the amendment applied correctly. While answering, focus on amendment types such as limit increase, maturity extension, margin change, covenant update, lender change, effective date control, approvals, and impact on future events. Question 14. What is a common production issue in Loan IQ, and how would you resolve it? A common issue is a transaction released in Loan IQ but not posted downstream to the general ledger. I would check the transaction status, accounting entries, interface logs, error messages, mapping rules, and whether the feed file was generated. If the issue is configuration or data related, I would coordinate with technology and finance for correction or replay. I would also document the root cause to prevent repeat breaks. Make sure to use a realistic example such as failed accounting feed, payment mismatch, stuck workflow, incorrect notice, or accrual discrepancy. Then explain investigation, correction, and prevention. Question 15. What should a business analyst or tester focus on during Loan IQ UAT? In Loan IQ UAT, I would focus on end-to-end business scenarios rather than isolated screens. Test cases should cover deal setup, drawdowns, rollovers, repayments, fees, amendments, notices, accounting, payments, and reporting. I would include positive and negative tests, such as insufficient availability or invalid value dates. Good UAT also requires clear expected results, evidence, defect tracking, retesting, and final sign-off from operations, finance, and agency users. In your answer, talk about end-to-end scenarios, deal setup, lifecycle events, accounting, notices, payments, limits, security, negative testing, reconciliation, defect evidence, and user sign-off. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.